Hello, everyone. So I'm going over brief exercise number 8. Presented below are data on 3 promissory notes. Determine the missing amounts. So the first part I'm going to do over what the maturity date is going to be. I found this to be, it's pretty simple. All you have to do is make sure you count the right amount of days. So you begin on April 1st, and it tells you that it's 60 days. So you just count 60 days from April 1st, which is the 31st. You do the same thing with July 2nd. With 30 days is August 1st. And for 6 months, you don't count days. All you would do is just add 6 months to the month of March, which makes it September, and it'll be September 7th. Now for this part here, where you're trying to figure out the principal, the annual, you want to use the principal, the annual, and the annual interest in order to figure out what the total interest is going to be. There's also going to be one more piece of information that you would need, which would be here. So here we have the face value of note, annual interest, and the other one time in terms of year. When you multiply those three together, you're going to get the interest. So this is the formula. I've written it out here so it's easier to see. So let's go back and see what's going on. So here it lets us know that we have $563,600 as the principal and 11% annual interest rate. To figure out what the time in terms of 1 year is going to be, this tells us is 60 days. So normally a year is 365 days, but in this case, we're not going to do 365 days. We're just going to do 360 days. So we're going to divide that amount by 360. And then we can go ahead and formula, which will equal the amount of the face value of the note, which is the principal, interest rate, times the time in terms of 1 year, going to give you 10,332.7 on, and we're going to do the bottom one first because it's similar to the top one. Over here, let's go back. So we have $126,560. We have a 12% annual interest rate, and it says here that the terms are 6 months. So when you're doing months, you don't divide by days, you just divide by months. So it's 6 months, which is equal to a whole year, which is 0.5, and you follow the same formula. 126,560 times the 12% times the 0.5 to equal $7,593.60. One, the middle one, all you're going to have to do, you're going to have to change the formula. So let's go quickly here so we can figure out. So we have 30 days. So we're going to take that 30 days, and again, we're going to divide it by 300 days, which equals to this. Now, to change the formula around, so all we're going to do is we're going to add annual interest rate on one side, and since these two, they're being multiplied, we're going to divide the interest by the face value of note times the time in terms of 1 year. So let's just put in the formula here. We're going to have the interest is going to be divided, and in parentheses, the face value of note times the time in terms of 1 year, close the parentheses, and it's going to be 9%. And when you plug it in, the answer just tells you to round up. So when we round up, 9.01% equals 9%. 10,332.67 equals 10,333. 7,593.60 is going to equal to 7,594.